Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Fiserv, ticker FI. I don't think I've analyzed this one on the channel before. This one came in by request down in the comment section of one of my other videos. If you have a request, put it down in the comments. I'll get the ticker up on the board and I'll leave you a note back to let you know that it's up there. So if it takes a couple days for me to do that, that's just because when I'm reading the comment, I'm not near my chalkboard, but eventually I will get it up there and I'll make a video. As always, this is not individual investing advice. This is just how I analyze stocks. And you can find all these YouTube videos over on my free tier on Patreon if you don't want to have to rely on the YouTube algorithm to find me. Okay, let's get into Fiserv. So I'm long this stock. We bought this one in the full Cyclical Investors Club service in, let's see, February 2022. I'll take a look at that in a second. But first, let's look at the historical earnings. They've basically been perfect. I think these guys do steadily buy back shares. So I don't think have they ever had a year without EPS growing. Doesn't look like it. It's kind of beautiful when you see that. One little snag it here, but other than that, and it wasn't negative, only 10% growth. So this is what you want in a business, right? I mean, it'd be fabulous if you bought this stock back 20 years ago. Let's just see how you would have done. You would have been up 2,000%, so 20 times. That's pretty awesome. Excuse me. So let's shorten the fast graph up here and get into how short do we want it? It doesn't matter too much because all these growth years are pretty similar. Now, a couple things worth noting. We did have a tax cut year in 2018. You can see earnings growth was a little bit higher in that year and then going into 2019. And then we had a bunch of stimulus in 2021. So we see earnings growth over 20% that year too. But even in the years where it's not like growing super fast, it's growing very well. Earnings have grown very well. Let's see. Through this time period, you're looking at 17.79% earnings growth. Now, when I take into account stock buybacks, that drops down to a little under 13%. So the earnings growth estimate I'm going to use is actually going to be 12.9%. So considerably more conservative than what you see here, but still really strong compared to a lot of stocks. So you can't really ask for like too much more. They had a little bit of M&A a few years ago. Let's see, I did make a little chat GPT of what they do here if we want to take a look at it or read it. So they're a fintech company in payments processing. They do accounting processes, point of sale for merchants with Clover, risk and fraud management, lending and credit solutions. Founded in 1984, and then when did they? Let's see. They acquired First Data in 2019. That was the M&A I was thinking of. So, pretty solid financial business. So when I bought it, let's see, February 16th, 2022. This is what happens occasionally, and why it's important, I think, to just track stocks sometimes. Because every now and then the market will just give you like a good deal. As we saw, earnings growth on the fast graph was like 17%, but still like low teens percentage growth is what I was calculating going into this. They were trading at like a 17 PE, and then the forward PE would have been a little less than that. So it just looked like a solid deal when I bought it there. And it's up over 100% now. Now we had multiple expansion. Obviously, it's up. The PE is up to 24. They just reported earnings today or last night, and the stock was up like another 7%. So it's even higher than that now. Really, it's just like one of those dream stocks that if you can buy it at a fair price, then you're going to do pretty well over the long term. So let's see here. Let's do a time until payback analysis, And what we'll see is how long it would take to earn your money back from their earnings if you bought the stock today. So if you paid $100 for the business, how long would it take the business to earn $100? It's a pretty good valuation technique. I might even go back and do it and see what it looked like when I originally bought it. I didn't use this specific method, but it's very similar to the method that I did use. So if we use a 12.9% earnings growth rate, which was conservative relative to the one you saw in the fast graph, that's going to produce a 3.68% earnings yield. The earnings yield is the PE ratio inverted, so earnings over price. So if you think about it this way, if you paid $100 for the business, in earnings the first year, you would earn $3.68 for every $100 of the business that you bought. And what you want to know is how many years it would take you to collect that earnings until it got to $100 worth of earnings. Now, each year, the earnings are going to grow 12.9%. And I usually pull the first year forward, so we can scroll over to the right here. I'm going to show you what that looks like. So, again, first year would be $4.15 you would earn, and then you keep that. And then the next year, you earn $4.69, and you keep that. And then $5.29, and that goes on. And you want to see how many years it would take you to get to turn your $100 to $200, and right now it would take about 12 years. So I would say I prefer to have this at about 10 years for a stock like a well-established stock that's in the S&P 500. And they probably have a decent sized market cap. Like they're probably a pretty good size. Let's see. Yeah, over $100 billion. So they're a big company. They're probably not going to be able to grow this fast, forever. And so you would expect eventually earnings growth would slow down a little bit. And so 12 years is not bad, but I would want it closer to 10 years before I would buy it. Let's see. I didn't calculate ahead of time what that price would be, but I did control for their debt as well here. So I'm treating this stock as if it's trading at $277 instead of $229. Let's see what it would take to buy it. So let's just test out some prices here. So 200, 190, 180, 170. Okay, more than one. Yeah, right in between 170 and 175. If you use that 12.9% earnings growth rate, is where it would become a buy, which really isn't too much lower than where it's trading now. That's about like we'll call it $55 lower than where it trades now. So it's still a fair value. The S&P 500 would take like 15 years to pay you back right now using the exact same kind of calculation. That's just my rough calculation for the S&P 500. If earnings growth slowed down, which might be the case, maybe it slows down to high single digits or something like that, then obviously it would take a little bit longer. But I think it's fairly valued here. So even though I have it and it's up 130% or something, I'm not selling it because it's not overvalued. It's still cheaper than the S&P 500, so I just keep hanging on to it, and hopefully it keeps compounding over time. And I wish I could more stocks like this kind of fell in my lap. I mean, this stock was purchased during the peak, one of the peaks of the S&P 500. If I was to in QQQ and all that, I mean, so yeah, the beginning of January 2022 was, I mean, we've gotten a little above that peak now. If you adjust it for inflation, it's not quite too high above that. But the market was very expensive, and Fiserv was just hanging out there. It was a good deal. Just do the math and buy some. And really stress-free. I mean, I hardly checked this one at all. And when all of a sudden the other day I looked and it was up over 100%. So now it could always come back to this mean, which would be, well, if it does at this point with earnings growing, and I was using forward earnings when I calculated that for this year too. If it does fall down to that range, then, it could be a buy again, because it doesn't have to be super undervalued, like some of the stocks you'll see, because they don't have a ton of debt. and they're growing fast. So if a business isn't growing very fast, then you need a deep value. But a 17, 15, 16, 17 PE like it was trading at in here, if they're growing teens, which they've grown earning 16% every year basically, and you pay 16, that's a PEG ratio of 1, It's just hard to find stocks like that. Now, I don't know every risk for the business. If we go back to the Great Recession that got down to a PE of 10, we'll call it ish. So if you're buying at 15 and it goes down to 10 or 9, that's 35, 40% drawdown potentially. So it's not like the stock price can't go down if there's a recession, and their earnings didn't even really drop. If their earnings dropped, it could go down farther. And then if you pay where it's at now, you're taking on more risk. So I would definitely like it to be more like a 10-year payback. And then if there's troubles and it takes 12 or 13, okay, that's fine. I mean, that's not the ideal, but you have a little bit more margin of safety, and you don't have to spend time with like sitting on a 50% loss, because usually people get tired of that and they sell it, and then the stock goes back and earnings rise and the stock goes back up. So if you found this one useful, I have a weekly picks over on Patreon for $25 a month. Those picks have been doing really well. I just started that in October. Everybody's liking it. So check out those links down in the description. I also have a 25% off affiliate link for Fast Graphs, which you see me using here. They have free trials there if you want to go give them a try. I put them and I use it, and I was using it before, and I contacted them and I was like, hey, do you guys have like an affiliate link? And they're like, sure. And so it's great because I can put that down there and get everybody a discount if they want to use it. I think that's it. I'll see everybody later. Bye.